Order block or fair value gap, which one makes the better entry for smart money traders? Well, the truth is, it really depends on what you're trading and what suits your style best. But don't worry, in today's video, we're going to break things down and give you some helpful insights into both of these entry methods. Here, we're looking at a bearish market structure. In the latest impulse move, there was a strong imbalance between buyers and sellers. That's what triggered this sharp drop. This kind of supply-demand imbalance often shows up as a fair value gap, which is basically a price void that forms between the wicks of 3 consecutive candles. Because of this imbalance, the price is now considered sell-side inefficient, meaning there wasn't enough selling activity to fully balance things out. That makes it more likely for price to come back up, revisit that gap, and fill it, helping the market return to a more balanced state. Fair value gaps can show up in different sizes and in multiple spots within a single price move, and each one needs to be approached a little differently, depending on your strategy. Take this first example. We spot a small fair value gap near a swing low. If we place our entry right at that FVG zone and set our stop just below the swing low, we get a solid risk-to-reward ratio. Our target could be set at the candle close or a recent high, giving us a clean setup. In this case, the stop is well protected under the swing low, and the target is realistic, even if the price starts to pull back. Now in a second example, we're looking at a much larger FVG zone. If we enter right at the beginning of the zone, or even in the middle, there's a good chance we'll get stopped out. On top of that, the risk-to-reward ratio just doesn't look great. And remember, we always want setups that offer a reward that's at least equal to or greater than the risk, ideally more than one. So, what's the better approach for these bigger zones? Simple, we wait for price to enter the zone first. Then, we zoom into a lower time frame to look for cleaner entries at more favorable levels. That way, we can manage risk better while still taking advantage of the setup. During a correction, you'll often see price moving downward, but that doesn't always mean the overall trend has changed. In these situations, we wait for signs of a potential reversal before jumping into a trade. Now, in our final example, there are multiple fair value gaps formed within one strong impulsive move. So the big question is, which FVG should we focus on? The key here is to wait for price to come back into these zones and then look for potential buy opportunities. But we're not interested in all of them, only 2 specific areas. Here's why. If we take the start and end of the most recent impulse move and apply a Fibonacci retracement, we can divide the range into 2 parts: discount, below the 50% level, and premium, above 50%. The first FVG sits above that 50% line, meaning it's in the premium zone, and that's not where we want to be buying. The other 2 FVGs, however, are positioned below and on the 50% level, in the discount zone, which is where smart money typically looks for long entries. That's why our focus is on these 2, they offer a better price and a higher probability setup. We're only interested in buying when price enters the discount zone, and there are a few good reasons for that. One major reason is that the market often targets early buyers, stopping them out before making the real move. A smarter, more conservative approach is to wait for price to dip into the discount zone before entering a trade. This not only increases the probability of success, but also helps us avoid getting caught in liquidity grabs. So far, we've gone over fair value gaps and how they can be used as entry points in different market conditions, and as you can see, the where and when of your entry really matter. Now let's move on to order blocks. So, how do we identify high probability order blocks on the chart, especially after spotting fair value gaps? The first step is to mark the candle that caused the imbalance. This candle is often considered an order block, because it represents a moment where smart money likely made a key decision. Just like with FVGs, when price pulls back into this zone, there's a higher chance it will reject from that level and give us a solid trading opportunity. Order block candles can vary in size and shape, depending on the price action. When we're dealing with a smaller order block, we might want to give the zone a bit more breathing room, either by widening the area slightly or by setting a larger stop loss if we're placing a buy limit there. Why? Because while order blocks are powerful tools, price doesn't always respect them to the exact pip. It's not a guaranteed bounce from the edge of the zone. Flexibility is key. When setting our entries and stop losses, it's important to stay realistic. If we're dealing with a large order block zone, it can be really helpful to zoom into lower timeframes. This allows us to look for confirmation and potentially catch a better entry point, one that gives us a more favorable risk-to-reward ratio. After doing a good amount of backtesting with order blocks and fair value gaps across different currency pairs, we've noticed that they tend to work best when a few key conditions are met. So, here are 3 simple rules to help you spot high-quality entry setups when trading with FVGs and order blocks. Rule 1. Go with the flow of the market. Before diving into any trade, it's a good idea to figure out which direction the market is moving. Are the buyers pushing prices higher, or are the sellers driving things down? Spotting the trend early on helps you stay on the right side of the action. When tools like order blocks and fair value gaps line up with the overall market direction, they can offer stronger, more trustworthy trade setups, especially in clearly trending markets. By keeping an eye on swing highs and lows, you can better map out the market structure and spot possible opportunities. But if the chart feels unclear or it's tough to tell who's in control, it's often smarter to skip that pair and look for one with a cleaner setup. Rule 2. Spot the liquidity and use it to your advantage. When you're reading a price chart, those classic support and resistance levels, especially equal highs or lows and zones with multiple rejections, aren't just lines. We think of them as liquidity hotspots. Why does that matter? Because liquidity is what really drives price. The market naturally gravitates toward areas where lots of orders are sitting. These zones are like magnets for price action. On the flip side, once liquidity has been taken out from a level, the market often moves away from it. With that in mind, it's common to see price grab liquidity before making a move toward an order block or fair value gap. These areas can trigger sharp reversals or strong reactions. So, it's often wise to lock in some profits before price hits those key levels, just in case a big rejection is around the corner. And finally, Rule 3, watch for the break of structure. A break of structure happens when price pushes through a level that previously acted as strong support or resistance, basically, a level where price kept getting rejected in the past. So, what does this tell us? It's a strong signal that the move isn't just a quick reaction, it shows real momentum and often hints at a trend continuation. When this kind of breakout happens, the demand zone, or supply zone in a downtrend, that triggered the move becomes even more important. Combining a break of structure with other tools like order blocks or fair value gaps can lead to solid trade setups. But which one works best? That really depends on a few things: your trading pair, your preferred time frame, and your overall strategy. Some traders find order blocks more reliable for certain assets, while others get better results using FVGs. That's why it's essential to backtest both on your chosen pair. This not only helps you understand what works, it also builds the confidence you need to trade consistently. As for us, we tend to favor entering trades at order blocks over FVGs, and we've got a few reasons why, but ultimately, it's about what fits your trading style best. Let's take a look at a real setup using the euro pair on the 1-hour chart. Recently, we saw a strong bearish impulse that broke through a key support level. This kind of break usually signals solid downside momentum and hints that more bearish movement might follow. Along with the drop, 2 fair value gaps were formed. The candle that kicked off this move becomes our key order block, and all these areas can serve as potential supply zones for a short trade. But jumping into a trade right after a big move like this, that's usually too late. The smarter move is to wait for a pullback, look for price to return to a more favorable level, giving you a better entry with a solid risk-to-reward setup. No matter where we enter, our stop loss should sit just above the candle that started the move. This keeps us protected from random price spikes. Our first target: the close of the candles that make up the recent structure. Even if price reverses later, it often reaches this level first. Now let's apply a Fibonacci retracement to the latest impulse. When we do, we notice something important: only one of the 2 FVGs sits in the premium zone. As mentioned earlier, we're only looking to sell from premium zones, not from discount areas. So, we can ignore the lower FVG as a valid entry point. What about setting a sell limit at the FVG? It might seem tempting to place a sell order at the FVG, but here's the problem. To stay protected, your stop loss has to go above the initiating candle. That makes your stop distance quite large. Even if you enter halfway through the FVG, your stop is still too big, hurting your risk-to-reward ratio. If you try to tighten your stop loss by setting it inside the supply zone, you expose your trade to higher risk, especially from potential liquidity grabs, those quick moves that take out weak hands before the real direction plays out. Even if you zoom in to a lower time frame for confirmation inside the FVG, the odds can still work against you. A more conservative approach, instead of chasing the FVG, we prefer to wait for price to reach the start of the order block zone. This gives us a cleaner setup, entry at the start of the order block. Stop loss just above the initiating candle. Target at the most recent market structure close. This method offers better protection and a more favorable risk-to-reward profile. Of course, this approach isn't perfect. Sometimes price reacts to the FVG and never comes back to the order block, meaning you miss the trade. That's just part of the game. But we believe it's worth it to pass on low-quality setups and stay patient for the clean ones. Patience and discipline are key. Learning to filter out mediocre trades and wait for the right moment is one of the most valuable skills a trader can build. Let's break down a live example using the pound on the 15-minute chart. The market is clearly in a strong downtrend, and we've just seen a fresh impulsive move that created a fair value gap. The candle responsible for this imbalance is marked as our order block, signaling a possible price rejection to the downside if price pulls back. Two entry options. We've highlighted a wide potential trading zone here. In these cases, we can either zoom into a lower time frame for a refined entry setup, or keep it simple and place the entry at the close of the initiating candles. For this example, we'll go with the second option. Since momentum is clearly bearish, there's a higher chance the price will tap into the FVG and continue downward. In strong trends, pullbacks are usually shallow, but as the trend weakens, corrections grow deeper. What happened next? If we had placed our trade directly at the FVG, we likely would have been stopped out. However, entering at the order block gave us room to set a safer stop just above the initiating candle, keeping us better protected. Later on, another impulse move forms a new FVG and another order block. Using the same logic, we place a trade again. This time, though, price shows only a minor reaction and breaks through the supply zone due to rising bullish momentum. So regardless of where we entered FVG or order block, this one's a losing trade. Looking ahead on the chart, we see another potential setup. If you're familiar with smart money concepts, you'll recognize the structure. There's a swing point followed by a weak breakout, and equal highs, a classic liquidity zone. Zooming in, you'll notice long wicks, evidence of short positions being filled with stops likely sitting just above. To the left, there's an imbalance and another order block, positioned above the liquidity. This gives us a high probability trade idea. Once price pushes above the equal highs and grabs that liquidity, we anticipate a rejection from the order block with possible continuation downward. So, we set a sell limit in the trading zone. Place our stop loss above the swing high. Boom, it's good. Trade 1, win, entered at the order block with a safer stop. Trade 2, loss, both FVG and order block entries failed due to strong reversal. Trade 3, win, both entries would have worked, but the order block offered a better risk to reward. 2 out of 3 winning trades with a positive risk to reward ratio above 1 reward, not bad for one session. Even with a solid strategy, losing trades are part of the process. That's why risk management is absolutely critical. You need a plan that helps you stay consistent and survive losing streaks so you're ready for the winning setups when they come. If you found this breakdown helpful, hit that like button to show your support. And if you're new here, don't forget to subscribe. We cover smart money concepts, real-time examples, and advanced trading strategies in every episode. See you in the next one.